the Sure Investing Podcast, investments and strategies to help you safely compound your wealth over the long run. Hi everyone. Today I'm excited to be interviewing Eric Ervin, the president and CEO of Reality Shares. Reality Shares is an innovative asset management firm, ETF issuer, and index provider that manages quantitative dividend ETFs that select individual securities using a proprietary system called DIVCON. Eric is also very knowledgeable about blockchain technology and has led Reality Shares to the launch of an ETF that invests in the leading global companies creating and implementing blockchain solutions. In this interview, we discuss the factors and strategies that drive Reality Shares' dividend offerings, the motivation behind its new blockchain fund, and why Eric thinks that blockchain has the potential to be as disruptive as the internet. Stay tuned for more. Well, Eric, I just wanted to begin by giving you a hugely warm welcome for coming on and being interviewed on the Sure Investing Podcast. We're really happy to have you.
Thank you, and thanks for having me.
No, it's our pleasure. I thought we could begin by just hearing a little bit about who you are and the work you do at Reality Shares, and I guess where you fall in the world of investing.
Sure. So we started the firm. I myself actually started the firm about 5 or 6 years ago. I was a financial advisor for many years, about 15 to 20 years at some of the major Wall Street firms, Morgan Stanley being the most prolific out of that category. And my clients were, they weren't billionaires, but they were certainly very successful, kind of in that $5 to $500 million net worth. And with that, they were a bit more conservative, but they were a little bit mistrusting of the stock market and the general kind of equity markets and capital markets. So they always wanted to have some defensive approach with that. And that spoke to me as well. So when I launched Reality Shares, it was with the idea of bringing good quality hedge fund style strategies or other strategies that just made sense institutionally to the individual investor that my neighbor could invest in. And that was really the first fund that we ever launched, was focused on a market called the dividend swap market, which is a really somewhat esoteric institutional market, kind of an alternative to bond type investments. So a lot more conservative, a lot more stable in terms of overall volatility, but also a lot less potential for reward. From that, kind of thinking with that quantitative mindset of building institutional quality portfolios, we built out a model to predict which companies had the highest potential for dividend growth, and then built out a couple of funds based on that, really, focusing not just in the rearview mirror and looking at which companies did grow their dividends, but which companies could grow their dividends in the future, which I think is probably the most important thing that people need to look for. And so we built out funds across that category. And then we also have a thematic approach as well. So we built out, the blockchain technology is really becoming prolific now and could be as big as the internet was to us in the 90s. And so in order to accomplish an investment vehicle for that, we built out an ETF and an index that will track the companies that are investing in blockchain technology and using that blockchain technology. And that really kind of brings us to where we are today as a firm.
Okay, so it sounds like you just take a very quantitative approach to the dividend growth investing strategies that a lot of investors practice individually.
Yeah, if I look back at my investing career from the first days, any time that I allowed my emotions to get involved in the process usually was a bad decision. And so the more I could take that out, I kind of grew up in the computer science world, and the more you can take process and build it into a system, and then take that system and implement it and trust it and have confidence in the system, the better off you are, because then you're less apt to monkey with the system. And most of the greatest money managers in history, if you ask them, do they have a system? They would all agree, yes, I have a system. Maybe they don't articulate it in writing, but you can. And if you just interview them right down to the, what's your process? What's your universe of stocks that you look at? What's the factors and the quantitative system that you use to model out those stocks, all the way down to, finally, when do you buy and when do you sell? You can write up that rule set and then fire the money manager and build out an index that's much cheaper and much more cost effective in order to create that same outcome, and potentially even a better outcome, because again, you're taking the human out of the equation. So that's really how we think of things: is write down the rules, create systems, use those systems, trust those systems, and then offer it in a transparent format so anyone can use our same research to build their own portfolio just out of our best ideas.
So what are the factors that you incorporate into your systems at your Reality Shares ETFs?
So in the dividend space, looking at dividend growers, we boiled it down to, and we analyzed about 40 different factors. What we really wanted to do was solve for that question of what is a dividend grower? Is it just a company that grew its dividends in the past, or is it a company that can grow its dividends in the future and has a higher aptitude to grow them, which is really what matters. Just because you grew your dividends in the past, like the dividend aristocrats or some of those other models, we feel like that's leads you into a brick wall potentially if you're in a crisis situation. A lot of those stocks ended up cutting their dividends dramatically. So 7 factors where we found to be most appropriate are dividend estimates, so analysts' Wall Street estimates for dividend growth, the free cash flow to dividend ratio, so how much is the company actually earning in real free cash versus how much is it paying out in the form of a dividend. And that would be similar to like a dividend payout ratio off of earnings, but earnings are a lot more manipulable. So it's easier to fake earnings than it is to fake free cash flow, and that's why free cash flow matters a lot more. The Altman Z-score, which is kind of like a credit score for companies, like a personal FICO or score for people, the Altman Z-score is that to companies. And so that also factors into the equation. And then how much is the company actually doing in buybacks? So if a company is buying back a lot of its stock and paying a dividend and they fall on hard times, they're more apt to cut the buybacks than they are to cut the dividend. So they have kind of an extra bullet in the chamber. Should they fall into tougher times, they can cut their buybacks and continue to increase their dividends. And then a couple other factors in there, and then that winds out to what we call the DIVCON score. And then we have a couple of portfolios that only select those leading dividend growers, or vice versa, that will also short those dividend cutters, those in the bottom tier of that index model.
That's super interesting. There's a few things that really stand out to me there. The first is your use of share buybacks as a measure of dividend safety. And interestingly enough, the sure dividend investment strategy, which is called the 8 rules of dividend investing, we use the same criteria on. And I've actually never heard of anyone else using it before, so that's super cool. The second thing that I found surprising was your use of the Altman Z-score, which is something that I've only seen in the writings of Tobias Carlyle. For our readers who may or may not be familiar with that score, would you be interested in providing some insight into what goes into calculating it?
Yeah, and so Ed Altman, he was really he's a professor at NYU and is really the father, or known as the father of distressed investing. He way back in the late 80s and early 90s, he was really instrumental, or his research was instrumental in this idea that you could actually invest in distressed debt or junk bonds and earn a profit. So investing in these companies that are right on the verge of bankruptcy, but perhaps their debt is trading at a far lower value than where it should otherwise be, or vice versa, knowing which bonds to avoid because the company is on the verge of bankruptcy. And so he, like us, created a methodology in order to quantify just how distressed a company is. And it uses a few things that we use, actually. So free cash flow is one of the factors that goes into it. The company's debt level, so their debt service to their free cash flow. So how much are they paying in debt service versus how much free cash flow do they have? What's their total debt to equity ratio? And there's a few other factors, and it's very transparent. So anyone can go on Google and search Altman Z-score in order to understand exactly what goes into it. But it comes up with an equation, and then anything that's less than, I think it's 1.3 on the Altman Z-score is considered a high likelihood of default. So if they're ready to default on their debt, they're probably not going to be paying that dividend in the near future. And vice versa, a company that has a really high Altman Z-score is less likely to default and also more likely to be able to pay their dividends in the future.
You also mentioned that you have certain strategies where you'll take long positions in companies that score well using the DIVCON model and short positions in companies that score poorly using the DIVCON model. Another investor who famously does that is Joel Greenblatt at his Gotham Asset Management. Would you say that he's been influential in the way that you've built up reality shares over time?
Yeah, my just DNA as an advisor and kind of my overall investment philosophy, it's to seek out opportunities, both long and short, to put yourself in the best position to where you can kind of, in my old days, to where you could tell a client or an individual investor to hang in there and be confident that you're doing the right thing. So trusting in systems, that's one, but also knowing that markets do correct. And there's times if you're long only, then you're missing a great deal of opportunity, but you're you're putting yourself in a position to where, really kind of a third of the portfolio could get wiped out just because the market corrects, and that has nothing to do with the quality of your portfolio. So generally, this and forgive this this term, but being long high quality and short low quality, or long quality and short crap, is a good overall strategy that lasts throughout time, because as markets go down, those lower quality companies are generally the first ones that portfolio managers will start to sell, and the higher quality names will be the last ones that portfolio managers or just the general market will want to sell. So you end up having a better, what we call downside capture, meaning you go down less with your high quality names than the market does, and the low quality names tend to go down more than the market. And so if you allocate it appropriately, which in our one fund, which is the DIVCON Defender, or DFND is the ticker, it takes a 75% long position in those DIVCON leaders and 25% short position in those low quality, the DIVCON laggards, we call them. And so those are the companies most likely to short or cut their dividend. So in a bear market, those are the companies you want to be short. And in the correction of 2008 and 9, that kind of back-tested model would have been down only around 3% in that time period versus the market, which was down almost 38%.
Wow, that is some fantastic downside capture, as you call it. Now, to my understanding, you have 3 or maybe 4 different ETFs that are based on the DIVCON system. Are the differences between the ETFs based on their long-short allocation, or are there other differences as well?
That's the key difference. So this DIVCON system is, and actually we've applied that same DIVCON methodology to small, mid-cap, and later we'll do it towards international companies. But for these 3, there's 3 ETFs that are based on the system. For these 3 ETFs, so we have the DIVCON Leaders, LEAD is the ticker, and all that does is it owns the leading DIVCON companies. These are the companies that have kind of over time and over the history of the model have never had a cut in the dividend, and they've also had about a 97-98% likelihood of increasing their dividend in the next 12 months. So I think of them as the highest potential for dividend growth, not necessarily on a binary basis, like a yes/no, but actually in growth rate, which is probably the most important. So these companies, on average, grow their dividends about 16% over time, versus the market of 7 to 8% over time. So almost double the S&P 500 dividend growth. And then the other fund, so the DIVCON Defender, which is a long short, takes a long position in those DIVCON leaders of 75% and a short position in those DIVCON 1 stocks, the DIVCON laggards. We go 5, 4, 3, 2, 1 is how we rank companies. DIVCON 5 is the healthiest, all the way down to DIVCON 1. And there might only be 10 or 12 stocks that actually fall into that DIVCON 1 category. And so at that point, it would just be shorting those 10 or 12 stocks. And then finally, the Guard portfolio, GARD, is dynamic. So instead of being long short all the time, knowing that stocks generally rise, what it tries to do is it has a mechanism that says risks are very high. And so it's time to be long short. And it goes to a 50-50 long short position, or risks are low of a bear market, and so it's in a long only position, and it's again just long those leading companies. So it's all the same stocks in all 3 funds. It's just that Guard is dynamic. It'll be long only at times and long short at other times. And then Defend is long short at all times, and then Lead is long only all the time.
The third fund you mentioned, the Dividend Guard ETF, I guess I have 2 questions about it. The first is, I presume the answer to this is no, but would that Guard ETF ever go 100% short?
And you're right. The answer is no. So what, again, kind of based on the system, what we figure is we never want to take on too much risk. So at that point in time, if the Guard indicator signals a bear market is coming, and it only looks at the market for really kind of prolonged bear markets, that's what it's trying to avoid. It's not really trying to avoid the next 5% correction or the next 10% correction. It's really looking for like the 2001 market tech wreck or the 2008, market correction, just trying to avoid those big mega bears. So what it will do is it'll drop your long only exposure to 50%, and then it'll add a short position of 50%. So your net position is neutral. You really kind of have 50% long, 50% short, but your overall exposure is 50% cash and then 50 long, 50 short. So that's the general gist of how it would do. And then it rebalances in order to maintain that balance until finally the market gets healthy again and starts to go long.
Do you have any funds who use short positions to create leverage, say 25% short and 125% long?
No, but we did, when we were developing the DIVCON system. So this is, I think, again, part of our transparency and our belief that, we just want to be there as really a research provider. And if someone wants to use our ETFs, that's great. If they just want to use our research, it's there for anyone to see. And they can go on and find a lot of this research at realitysharesadvisors.com or at realityshares.com. But the thought is should we create like a 130-30 structure where it's 130% long and 30% short constantly? And actually the returns are quite good on that strategy. So, but we didn't want, you have limited bandwidth, just the market's ability to understand your product's offerings. So we wanted to just keep it to the 3 funds: long only, long short, and then dynamic long short type product.
Now, it's very clear just from this discussion that you have a focus on using quantitative screens and quantitative investment strategies to remove a lot of the emotional biases that impair long-term investment returns. Do you think there's any scenarios where human investors will actually outperform a quantitative system?
Yes, but maybe not consistently. And so there's certain examples where the human gets involved, the human makes a good decision. Maybe it was perfect. Maybe it was a perfect decision. They got out of the market at the top, or they got into the market at the bottom, or something thereabouts, or they were better at selecting a company and a portfolio and outperforming. But generally, those humans will then make a bad decision at some point in the future, which will negate those earlier great decisions, or vice versa. And so if they have a system involved and they can implement that system and trust that system, then they're essentially doing what we're doing, and they're just taking themselves out of the equation. So I do feel like, humans can do a great service for themselves the more that they can write down their own investment philosophy into a rule set. And that's essentially what we do. We do have certain, like, for example, in the blockchain sector, so there you need humans because that technology is so new. You need to be able to understand. You can't just do it with the number of patents companies have filed, for example. You have to have some humans in the system deciding whether or not the economic impact to this company is going to be as great based on their technology solution or not, whether or not this company is just faking it. And so you need software engineers, you need other people who understand the technology and the business of blockchain to evaluate these companies. But what we do is then use those humans in order to input a score. So that on a 0 to 10 basis, for example, what will be the economic impact to IBM if their blockchain initiative is successful? And then so we'll score that, and we'll have multiple people scoring it in order to come up with an ultimate score for the blockchain economic impact of IBM, as just to use that analogy. So humans can still get involved, but the human has to create a system that you can quantify and then replicate on an ongoing basis. And that's the general, where you kind of quantitative meets human involvement, but they end up with a quantitative solution and an outcome that can be trusted.
That's a great segue into blockchain because you're launching a blockchain-focused ETF, which implies that you think that this technology really has something to it. For the average Joe listener to this podcast, I was wondering if you'd be interested in providing a broad overview of what blockchain technology is and why you think it's important enough to create an ETF to give exposure to self-directed investors.
Yeah, and so I'll do my best at kind of explaining at the surface what blockchain is, and then a couple of use cases, and then we can take it wherever you like. But think of blockchain as a distributed database where everyone who has access to this database, most of the time these are fully distributed, but there are examples of some private blockchains where everyone has access to this database. And therefore, there's no need for everyone to keep their own copy of different databases and reconcile those copies. A good example of this might be, in the stock market. So right now, if I have shares of IBM, my broker is telling me, or my brokerage firm is telling me, or my custodian, how many shares I own. And I'm trusting that they have that data right. But then if I sell those shares to someone, I have to tell my broker to sell the shares. My broker then tells the exchange to buy the shares, or, sells them to someone else. Someone else is trusting their custodian or their broker in order to evaluate those shares. And then, of course, the exchange has its own copy of who bought and sold shares. And then in the case of the United States, the DTCC, which is the trust company, which everyone subscribes to, also keeps copies of this. And every back office of every one of those organizations has to come together and reconcile their own databases in order to evaluate who now owns the shares. And then when IBM goes to send out a vote request for the share owners, does the vote request go to my broker or does it go to the other broker? And it costs a significant amount of money, time, and human resources in order to do this entire process. If that was done in a blockchain, as an example, it would be one database of I own the shares. If someone else wanted to buy the shares would be instantaneously transferred. There wouldn't be any settlement. The money would be automatically placed into my account. I wouldn't even need to pay my broker as a custodian of my shares because they'd be held on the blockchain. If the company IBM, say, wanted to do a shareholder vote, they would instantaneously know that I no longer own those shares. Someone else owns them, and that other person could vote in order to cast their vote to IBM, and it could all be tracked without a whole host of intermediaries and costs associated with that. So it was really developed, many people have evaluated it as Bitcoin, and Bitcoin is blockchain. Bitcoin is really the first killer app that the blockchain technology was developed underneath. So just like email was kind of the first killer app of the internet, but the internet went on to be so much bigger than email. Same thing is true with blockchain. Bitcoin was the first killer app on blockchain technology. And blockchain technology is so much bigger, and the potential for blockchain technology is so much bigger than Bitcoin even.
It's clear from those comments that you think blockchain is going to be tremendously disruptive. How would you say that individual investors can position themselves in a way that they benefit from this trend?
Yeah, so if you take that analogy of the internet, just like the internet became pervasive across every single segment of the economy and every single industry, really from hardline manufacturers to railroads to shipping companies, there's so many different either revenue opportunities or cost reduction opportunities with the advent of the internet. The same thing is going to happen most likely with blockchain. Back office infrastructure can get reduced down to a simple technology click of a button, and to use it in the case of the supply chain. So IBM has already worked with Walmart in order to create, and not just Walmart, but Walmart and Nestle and several other food companies, in order to build out a solution for the supply chain. So when a mango is shipped from the farm to the trucking company, and the trucking company to customs, and the customs to the new importer, and so on, all the way right down to the shelf of Walmart, they can tell if there's a food poisoning outbreak. They know exactly where the mangoes came from. They no longer have to take off billions of dollars worth of items off the shelf. Now they can just take off those items that are infected. And so they estimate that it will be billions of dollars in cost savings just because of this supply chain initiative. And they can do it in seconds now instead of what would have otherwise either been impossible or taken multiple weeks in order to evaluate where it came from. So that's kind of one example of that. What other companies, certainly in the financial system, have been looking at is just cost savings. From, I would say, if you take the entire GDP of the financial system, a good double-digit percentage of that is easily allocated towards cost in terms of transactions. So just moving wire transfers from one place to another, to custodying assets, and kind of that overall friction of keeping that database and keeping that ledger. And now with blockchain technology, a lot of that can be alleviated with these shared databases where companies have access to the ledger on a shared basis, and they no longer need all that back office infrastructure. So one is cost savings, and then the other one is real revenue growth. As IBM works with more and more companies, IBM sees it as a huge revenue booster. Intel is a good example, and Microsoft are actually completely reinventing themselves, where now blockchain as a service, just like software as a service with Salesforce and a lot of those companies, blockchain as a service is now going to become a huge percentage of their revenue growth in the future, because they can now offer this in the cloud, and they're the sole kind of really dominant player in this blockchain as a service arena. Intel thinks their chip sales could go up almost 20% just from this one thing, because of the way that the chip is designed. It's fully encrypted. So data comes in on an encrypted basis, it gets decrypted, calculated, and then it goes back out on an encrypted basis. So if anyone, evil at Amazon, for example, on their web services wanted to peek in and see what was happening in this blockchain, they wouldn't be able to do it because it's more secure, but it stays distributed. So more and more people have access to that ledger. So there's just a number of different ways and different companies that you can kind of get access to either cost savings or revenue increases. And what we decided to do was just score every company, just like our DIVCON system, score every company based on their blockchain score. What is their impact in the blockchain arena? And then rebalance that portfolio every 6 months so you can constantly see the new portfolio of companies that have the highest blockchain score in that arena.
And what factors go into the scores that you assign to these blockchain opportunistic companies?
So we did it on a kind of two-factor. So there's 7 different factors that go into it, but we did it in a dual path. One is a little bit subjective, and this is where we wanted to build out a blockchain advisory board that could help us answer some of the tougher questions on which companies are frauds and which companies are legitimately implementing the technology. So we look at the number of patents that the companies have filed. We take every company in the globe and analyze these different things. So are they publicly traded, for one? Do they have a market cap greater than 200 million? Is their trading and liquidity, greater than, is the turnover in the stock liquid enough to support investment from individual investors? Then the 7 factors are: how many patents have they filed? Are they a member of a blockchain institute? There's a number of different organizations or initiatives where people can become members, or companies can become members of these institutes. And then what level of membership are they? And then what about their role in the blockchain ecosystem? Are they a developer, an implementer, or a investor in the blockchain space? Are they kind of providing consulting services like Accenture, or are they actually selling technology like NVIDIA and Intel? Those would be the suppliers. And then what is their blockchain economic impact? So are they just playing around with the technology right now, and so even if blockchain is wildly successful, their stock's not really going to move very much? Or are they all in on blockchain technology, and this is really the future source of all of their revenues or cost savings, and so it's meaningfully going to impact the stock if blockchain is successful? So we measure these different things, and then we have these blockchain advisors, such as Jeff Garzik, who was one of the original Bitcoin core developers. He had worked on the software, with the famous or infamous Satoshi Nakamoto in the kind of the creation and development. And he can actually look at the source code of a lot of these different blockchain related businesses and decide whether or not this company is genuinely actually implementing a solution, or whether or not they just copied somebody else's source code and they really have no interest in building out their own blockchain solution. They're just doing it for pure hype. And so we'll evaluate these companies based on each one of those scores, and then kick out the companies that don't make it, accept the companies that do, and then only invest in the companies that have a blockchain score of 50 or higher.
That's super interesting. There's lots of blockchain-related financial markets behavior that is almost reminiscent of the stock market bubble of 2000, 2002, the internet bubble. Do you have any advice for investors who want to gain beneficial exposure to blockchain but are feeling nervous or anxious about potentially investing in the next pets.com?
Yeah, and I think that's probably the biggest problem for a lot of this. And unfortunately, it puts a little bit of a black eye on the technology. The technology is very sound and really like being used in across almost every different sector of the economy. But there's a lot of fraudsters, and there's a lot of companies that are just changing their name and not actually implementing solution. Like even say the pets.com, creating a business that's purely based on hype and fluff. So what I would suggest they do is definitely take a look at our ETF, BLCN, look at some of the holdings in there to evaluate which companies are legitimately implementing blockchain solutions, and then look at some of the holdings that are not in there. Like, for example, Riot Blockchain Technology. That's just a kind of a scam. That was a company that just changed their name to Riot Blockchain. They haven't done anything related to blockchain. They've done several secondary offerings. They've sold a number of different items of stock and share offerings. And the founders, or the original kind of core investors, have sold a number of their own shares. So that's another company that is doing something more on the hype basis and not on the real justified blockchain initiative. Kodak is another one that remains to be seen whether or not they're actually implementing a solution. They just took over a previously announced ICO and then put it into their own name, and then created this kind of, so anyone who does their research is able to evaluate that and know that that's not a legitimate player in the space. What their use case is actually quite interesting. So this ability to track photography or digital assets on kind of on a blockchain, that is very compelling, but they're not actually doing it. They're just talking about it. The real invention that Bitcoin solved is a way to make sure that if I own something digitally, you don't own it. And that's really what Bitcoin was. So if you take every dollar bill here in the United States, if you look at a dollar bill, it has a serial number on it. Imagine if you could put every dollar bill into a digital form, and we could ensure that if I gave you my dollar bill, you knew I didn't give it to anyone else. That's what the blockchain does. So now take that same concept and apply it to digital images, or an article, or this podcast, for example. This podcast is going to go out and it's just going to be a series of zeros and ones. And so if I pay for this podcast, what if there's a smart contract that's embedded into those zeros and ones that knows that there can only be one owner of this podcast, and I own it, and I own it for my own use, or I could sell it, or potentially anyone can download the podcast, but if it's used for commercial purposes, that automatically a payment is made back to the owner of the podcast, or the creator of the podcast. That's really where you start to see the opportunity in blockchain, but it also presents another question mark of how the heck is all this going to happen? And it's just going to take years of time in order for the technology to evolve into all of these different use cases. But everything else in our lives is now digital. It's about time that our money and our assets become digital as well. And that's kind of the innovation that blockchain is able to solve for.
Throughout this call, you've given some really fascinating examples of the use case of blockchain technology. And you haven't not once really mentioned Bitcoin or gone into much detail about it anyway. So I'm curious what your thoughts are on Bitcoin, because there's plenty of people who see it as a store of value, and you see comparisons between Bitcoin and gold. And there's other people, like Warren Buffett has said that if he could buy 5-year puts on cryptocurrencies, then he would. So I'm curious, as someone who knows a lot about blockchain, what your thoughts are on Bitcoin.
Yeah, and I spend a lot of time differentiating the difference between what blockchain as a technology is and what cryptocurrencies are. And I think initially in my journey down the rabbit hole of learning about a lot of these things, I think I started out as being a bit of a cryptocurrency skeptic. But over time, I've not only come to kind of be really passionate about the technology itself, blockchain, and all of its different uses, but also actually to be a bit of a believer in the cryptocurrencies themselves, not necessarily knowing that where it's going, but knowing that we're just getting started here. And so I do feel like everyone should own a percentage of their net worth in cryptocurrencies as almost like a call option on the future. And by a certain portion, I'm talking like 1% to 3%. It's just far, far too volatile to own much more than that. But because it has this asymmetric risk reward profile, I mean, if you price it right, and let's say you allocate 3% of your net worth to it, the most you can lose is 3%. Markets do that in a month, so stock markets and even potentially bond markets can do that. And yet you have this potential payoff that could be 5, 10, 15 times that original investment. They don't show any correlation to the other asset classes. So you can truly treat it like a different asset class. But if it's sized appropriately, I think it makes a lot of sense for investors. The problem is there's just so many things to watch out for. So there's scams, there's hacks on different exchanges. It's important to know that there's never been a hack on the Bitcoin blockchain. So the blockchain itself is very secure, incredibly secure. And many users might ask, well, how is that possible? Anything with cryptocurrency or anything with technology can be hacked. Why is it that a blockchain is so secure? And the key thing I think or analogy that somebody gave to me was, imagine, because it's so distributed, so imagine your dollar bill is held in 1,000 different houses. And so in order for someone to steal your dollar bill, they have to break into every single one of those houses and change the ledger, or break in and steal a piece of that dollar bill from every single one of those houses to make sure that they own your dollar bill now. And it's just not worth it to them. It would cost more in electricity just to hack into all of those different computers and all those systems to steal something. And that's why the Bitcoin blockchain or many of these other cryptocurrency blockchains are so secure. But by storing your cryptocurrency in a place like Coinbase can be hacked because it's a centralized exchange and custodian, just like JP Morgan could be hacked. So that is the kind of the key differentiator, is the blockchain itself has never been hacked. So if you do own cryptocurrency, you have a lot more issues around storing your own assets. But I do feel like it's a potential asset class. It's a store of value. It's a very volatile asset class, and it will be as it continues to go higher and higher and higher. And all of that volatility will keep, hopefully, a lot of the inappropriate monies from going into it, and keep just kind of that speculative capital investing in it, because that's, I think, what it needs. It needs this bit of speculation effect in order to grow the network, in order to grow the trust. And then as it gets more and more trusted, it becomes less volatile over time. But that could take many, many years, decades, in fact.
You mentioned, a 1% to 3% allocation to cryptos would be appropriate for many investors. Would you recommend that people just buy Bitcoin? Should they buy a basket of cryptocurrencies? Should they buy only several? What are your thoughts on that?
So this is actually one of the next businesses that Reality Shares is going to start to build out, is a way for people to get access without all the complexity of public and private keys and a lot of the other things. So they can invest in a portfolio of the top cryptocurrencies, so treat it almost like an index portfolio of kind of the main cryptocurrency assets. But without that, here's a couple of things that you need to know. So Bitcoin it is certainly the most dominant. It is the most secure of all the blockchains. The more it goes up in value, the more miners, which are really just computers on the network, or players on the network, that are keeping it secure. So the more they come in and keep it even more secure. So it has this kind of self-fulfilling benefit to it. However, it has a lot of other issues, which are downsides. So it's difficult to scale. Bitcoin can only do about 7 transactions per second, whereas Visa can do about 7,000 transactions per second. So that original promise of being, this internet money where people can buy and sell goods for nearly no cost, it's cheaper than a wire transfer, that's no longer necessarily the case. The average transaction fee now is around $30 to $40 for one Bitcoin transaction. However, most of the software developers that are coming into the space are starting there, and they're working on Bitcoin because it is the most interesting and it's the longest dated blockchain that we have. And so that's where all the brightest minds are. TCP/IP wasn't scalable. You couldn't do video, you couldn't do audio. Everyone said that it was a terrible protocol and there were much better internet protocols. But that's where all of the best and brightest minds came, and that's where they solved those problems, to where now we have, we're able to make this call together over the internet, and so it's very likely that people will scale and solve those problems of Bitcoin. So I do think Bitcoin is going to be your core, And then Ethereum is a completely different asset. Ethereum is actually kind of this global computer, and Ethereum is the currency or the commodity that allows people to use this global computer. You can have things like smart contracts where in the future, my autonomous car could be out Ubering people around and it would be getting paid while I'm sitting here at work. That can only be done with blockchain related solutions. So you're going to need something like an Ethereum or some other corresponding blockchain for things like that, where smart contracts can actually take place on a blockchain. And a smart contract, another great example of a smart contract is let's say flight insurance. So many people buy flight insurance, and many people miss their flights. But it's such a pain to go back and to try to reclaim those dollars from the flight insurance that they never end up getting paid. If that flight insurance was done with a smart contract, it would know that you didn't make your flight and it would automatically pay you, and you wouldn't have to do anything beyond that. If you miss the flight, you're automatically paid or compensated for that flight insurance. That can only be done with a blockchain related solution and a digital currency in that vein. So Bitcoin and Ethereum for sure. And then what I would suggest is maybe the top 3 or 4 other coins beyond that. So Litecoin is like the silver where Bitcoin is gold. So you can process transactions a little bit faster on the network. And then just take a look at some of the other ones from there. And again, we're not trying to make investment recommendations right here, but these are just my personal opinions. So definitely don't overdo it, for your listeners and your audience. Like I say, 1% to 3% allocation. Know that anything you're putting there could very well go to zero, but it could also be kind of the next big thing. And that's where, again, I think if it's sized appropriately and you know what you're getting yourself into, then it makes a lot of sense for people.
Do you see any way in the future where blockchain technologies can meaningfully disrupt the investment advisory industry?
Oh yeah, just like so I think first there was the robo advisor that came on the scene, and I think that there was an awful lot of hype and a lot of interest in that, and certainly a lot of venture capital dollars, and I think that that's yet to be proven. Really, as there's just several $billion in robo advisors. It's not even several hundreds of billions of dollars. So the financial advisory world is still that human interaction is still really important to the individual client. But the E-Trades and the Schwabs and, a lot of those types of solutions have taken a significant amount of dollars from the old traditional financial advisors. So advisors have had to innovate. They've completely changed their business model from a stockbroker style business model to a financial advisor who also manages money for a fee. And maybe in the future, it might be a financial advisor who advises on clients for a fee, but it doesn't have anything to do with the assets under management. It has more to do with the advice given based on those assets. And because everything can be transferred and custodied on the blockchain eventually, the advisor can't necessarily say, I'm your custodian, you pay me a fee, or I'm your intermediary between you and the custodian, you pay me a fee. The advisor is going to have to think about new ways to create a business model where they can offer the advice without that custody. Because once you have custody, the client's really handcuffed to you as a financial advisor. Once you lose that custody relationship, the financial advisor and the client have to have a personal relationship with one another. Otherwise, the client's never going to want to pay the fee. And so that's going to be kind of the interesting. But again, this is probably 5 to 10 years out, over the next 5 to 10 years that this takes place.
So you see this as a win for investors overall?
Yeah, just like the ETF industry was a huge, it's still continuing to gain, massive traction and massive adoption from mutual funds. The fees came down significantly. The amount of total fees that are paid to the ETF industry is really around $5 billion or so. So that's the overall revenues of a $3 trillion asset management pool. That would have been about $15 billion if it was in mutual funds. So a huge benefit to the consumer and a tough battle for money management firms. But that's all good for the consumer. So just like any time a new technology comes in, it just eats away at the margin of the incumbents. Like Amazon, when they came in, Amazon's opportunity is someone else's margin. And the same thing is going to happen when it comes to blockchain. JP Morgan, the reason that they're so nervous about blockchain is because it could potentially put them out of business. Same thing with, the post office and email, right? So it's just going to be a great thing for the consumer and a really challenging thing for anyone who acted as an intermediary, a la financial advisors, custodians, banks, really kind of across the board. There's so many different intermediaries. Even Uber and Airbnb, who came in and completely disrupted two well-established industries in a heartbeat, basically, could now be completely disintermediated because of blockchain. There's no more need for me to go through Uber to get a driver when that driver posts that he has a location, or he's near me, and I post on the blockchain that I need a driver. Instantly, the two of us meet up. We just cut out 30% of the cost of that intermediary, which is Uber. Same thing with Airbnb. You put your apartment for let on the Airbnb blockchain, for example. I say I need it. We interact with one another on the blockchain. There's no more need for Airbnb to take that middleman fee. So anywhere there's a middleman or an intermediary, they have to really be thinking about new ways to invent themselves using blockchain technology. Otherwise, they're going to get completely taken out.
Now, what are your thoughts? Just is going to circle back to Bitcoin a little bit, but I'm curious as to what your thoughts are on the comparisons between Bitcoin and gold.
Yeah, and actually, so this is another question of, gold was always known as a store of value for many, many years, and because it's known as that, it's become a store of value. So there's a little bit of that self-fulfilling prophecy of if people believe it, then it starts to become it, and so on. And I think we've been around for long enough, or we've seen Bitcoin stay long enough to where people are going to start to treat Bitcoin as a similar store of value. If you're, here in kind of the United States and Canada and kind of the first world, we don't have a lot of the problems that people do that live under oppressive regimes and otherwise. But if you needed to get all of your assets out of a country, it's not easy to convert them into gold and then flee the country with all these bars of gold. You can do it in a heartbeat with Bitcoin. If you store your assets in Bitcoin and you can leave the country, you now just left with 100% of your wealth intact in milliseconds. Really, as long as it takes to do a transaction on the Bitcoin network, you're done, and you can transfer anywhere around the world with those assets. So I think that for a store of value, it becomes even more accommodative for people who live in difficult regimes that have a harder time storing their wealth in a kind of safe format from oppressive dictators and whatnot. It also builds out an entire financial system for the unbanked. There's so many people around the world, in Africa and other third world countries, that don't have access to banking. They don't have access to lending. They don't have access to even their real estate. In South America, if a dictator comes in and says, you no longer own that real estate, my friend does, you have no recourse. But if it's all posted to a blockchain, then there's an accurate record and no one can tamper with that record because it goes all the way back to the beginning of the blockchain. So that's where you start to see kind of the unbanked becoming now part of this financial ecosystem, and they can store assets, and therefore they can get loans, and they can be more productive in the world where they could otherwise have been just shut out for life. So it's really kind of like a big game changer for the way society is going to operate in the future. I think the thing is, and more people will adopt it instead of gold. And that doesn't mean that gold will lose its value. In fact, there's certain ways that, like the London Metals Exchange, I think, is already issuing a gold-based cryptocurrency. So you can trade like bits of gold on a digital format, and you can transfer them digitally on a blockchain-related solution. They work with the CME in order to do that. So you're seeing blockchain done in a lot of different ways, but there's still going to be these decentralized systems like Bitcoin, Ethereum, where there's no, like if you wanted to shut down Bitcoin, you can't do it. There's too many computers around the world. No government can shut down Bitcoin. Bitcoin can't just decide to stop. There's no, you on your own personal computer could have a node operating the entire Bitcoin blockchain. And so you have your money right there. So that's the real kind of benefit of a decentralized system such as Bitcoin.
My last question for you is this. Do you see any big opportunities for blockchain disruption that aren't really being captured by any companies or individuals right now?
Like any new technology, think about this as, to use that analogy of internet, this is really early days of the internet and it's pre-Netscape. So the internet was, I remember, in the early days, it was just a black screen and I would hit tab, tab, tab to get to the next link. There was no mouse there, so it was really cumbersome for the average person to use and see the value in internet. I think that's kind of where we are with blockchain and a lot of these cryptocurrencies. So we'll have years before there become these on-ramps to the system where anyone can get access to it and see it and use it and feel it in their lives and their daily operations. But one other outside of finance is healthcare. So if right now we all store our personal medical records with our different healthcare providers, and those healthcare providers get hacked into all the time. And so that's our personal healthcare records getting out there into the investment or into the public's hands. From there, they can forge documents. They can create all sorts of fake prescriptions. We have a huge opiate crisis here in the United States and around the globe. If because of this concept on the blockchain, no two people can have the same digital record of something. So there's only one prescription that gets issued. There's only one human that can take exposure to that. If all of the pharmacies are on that same blockchain, they know if somebody is going into two different pharmacies and trying to fill the same prescription twice. So it prevents so much fraud, along with kind of bad things getting out onto the streets, because there's only one digital record of it, and so therefore you can't have those duplicates. So I think that's going to be a big one over time, and the thought of putting your public profile out on a blockchain, your health records, your DNA, your all of these different things on a blockchain is frightening to some. But just to put some clarity to that, you're not putting your data out there. What you're doing is think of it like a Swiss bank account, a Swiss numbered account. You're just putting a number out there. That's your identity. That number represents you. And so that digital record of you can't be duplicated. That's what is on the blockchain. So you can see anyone and their assets, you can see anything, but all you can see is a number. So you have no idea who that person is behind that number. And that's why it's a lot more secure, but it's also transparent.
Awesome. Well, you've really given our listeners a lot to think about, so I wanted to thank you a bunch for your time today. It was a real pleasure interviewing you, Eric.
Yeah, no, thank you for having me, and I really look forward to hearing future episodes of the show. I'm really excited for you guys. I think I've been a longtime reader of the program, and I know you guys put out great stuff, and I can't wait to hear some of these other interviews that you guys are going to do.
Thanks so much for listening to today's episode, everyone. I invite you to check out our website at sureinvesting.co, see our premium investment research at suredividend.com, and also check us out on YouTube, where we publish videos under the name Sure Dividend. See you next time.